The birth of the petrodollar and America's 50-year advantage in the early 1970s. The global monetary system entered a moment of deep instability. The United States had just severed the convertibility of dollars into gold, ending the Bretton Woods system that had stabilized world currencies since World War II. As countries realized that the dollar could no longer be redeemed for a fixed amount of gold, confidence in the U.S. currency faltered. Inflation surged, the dollar weakened, and America's role as the anchor of global finance came into question. Something had to replace gold as the foundation of the dollar's global power, and fast. What emerged from this moment of crisis would become one of the most important and least understood financial arrangements in modern history: the petrodollar system. Although not established through a single treaty, the mechanism took shape through a series of geopolitical understandings between the United States and key oil-producing nations, especially Saudi Arabia. In practical terms, the arrangement worked like this. Oil, the world's most essential commodity, would be priced and traded almost exclusively in U.S. dollars. In return, the United States would provide military protection, political stability, and security guarantees to the Gulf monarchies. This created a powerful economic engine. Every country that needed oil, which meant every major economy on Earth, was now required to obtain U.S. dollars. This ensured constant global demand for the American currency, regardless of America's domestic economic performance. Even nations with tense relations with Washington still needed dollars to buy energy. From Tokyo to Paris, from Buenos Aires to Seoul, governments had to maintain dollar reserves, participate in dollar-based banking systems, and interact with American financial institutions. For the United States, the benefits were extraordinary. Because the rest of the world had an endless appetite for dollars, America gained the ability to borrow cheaply and perpetually. Massive government deficits became manageable. The Federal Reserve could expand the money supply without immediate collapse of the currency. The U.S. could run trade deficits for decades, buying goods from abroad while paying with paper claims the rest of the world continued to hold. In essence, the United States gained what many economists describe as a 50-year free lunch: the privilege of issuing the world's primary reserve and settlement currency. This privilege extended well beyond oil markets. Global shipping, commodity trading, international loans, and cross-border investments all gravitated toward the dollar. Even when other currencies rose in prominence, none came close to replacing the dollar's liquidity, stability, and network effects. Major institutions, the IMF, World Bank, SWIFT banking rails, were built around the dollar system. To operate in global markets was to operate through the American financial architecture. But hidden within the success of the system was a structural vulnerability. It relied on a world where nations remained willing to settle critical transactions in dollars, even if doing so bound them to political and economic influence from Washington. For decades, the advantages outweighed the costs. But the world of the 1970s, dominated by a single superpower, is not the world of the 2020s. As rival powers emerged, as geopolitical tensions escalated, and as new financial technologies developed, the incentives that kept the dollar entrenched began to weaken. Nations sought autonomy, alternatives, and insulation from American sanctions. The petrodollar system, long taken for granted, started to fray at the edges. For the first time in half a century, major exporters, including several in the Middle East, Asia, and Eurasia, began experimenting with non-dollar oil payments. The system that had quietly underpinned global finance for decades began to show cracks. It's not because of a single dramatic event, but because of a slow, cumulative shift in global power dynamics. How a geopolitical arrangement created an unprecedented era of American financial privilege. But to understand why that era may be ending, we must explore the forces driving the world away from the dollar and what happens when a system, dependent on network effects, begins to unravel. The rise of de-dollarization, and why it's accelerating now for decades. The idea of a world moving away from the U.S. dollar was a topic reserved for fringe analysts and contrarian economists. The dollar's dominance seemed unshakable. Most global reserves were held in dollars. Most international trade was invoiced in dollars. And the United States enjoyed unmatched military reach, deep financial markets, and a reputation for stability. But starting in the late 2010s, and accelerating sharply after 2020, the conversation changed. What was once theoretical gradually became observable. The central trend driving this transformation is de-dollarization, the growing effort by many nations to reduce their dependence on the U.S. currency. This shift doesn't come from a single cause. Rather, it's the result of multiple global forces converging at the same time. First, geopolitical friction plays a major role. Many countries have faced sanctions or the threat of sanctions from Washington. For them, the dollar isn't just a currency, it's a tool of American power. When international payments are routed through New York banks, they fall under U.S. jurisdiction. This gives Washington extraordinary leverage, but creates incentives for other countries to bypass American systems. Russia, Iran, and Venezuela have long been seeking alternatives. China, India, Saudi Arabia, Brazil, Turkey, and even us allies in Europe have begun exploring options to reduce vulnerability to Washington's financial reach. Second, the global economic balance of power has shifted dramatically. In the 1970s, the United States accounted for nearly a third of global GDP. Today, it accounts for about a quarter, still enormous, but no longer dominant. Meanwhile, rising economies, especially China and India, have become central players in energy and manufacturing. As trade patterns shift eastward, the idea of pricing transactions in local currencies becomes more practical. China's push to internationalize the yuan through swap lines, digital currency initiatives, and energy partnerships directly challenges the dollar's centrality. Third, technology has eroded barriers that once protected the dollar. Digital payment rails, central bank digital currencies, and regional clearing systems allow countries to settle transactions without relying on SWIFT or U.S. banks. While none of these systems yet rival the scale and liquidity of dollar markets, they create a growing web of alternatives. When nations possess multiple credible settlement pathways, they no longer need a single dominant currency. Fourth, energy markets, the backbone of the petrodollar, have become more diversified. The rise of renewable energy, shifting alliances in the Middle East, and new supply routes have all reduced the reliance on the old U.S.-Saudi framework. Major exporters like Russia and Iran already sell oil in non-dollar currencies. China has signed long-term agreements to purchase energy in yuan. India has begun paying for oil imports using rupees with several partners. Even traditional U.S. allies have indicated openness to accepting payments in other currencies. These forces have measurable consequences. The dollar once represented more than 70% of global reserves. Today it sits near the upper 50% range. The share of global trade invoiced in dollars has also fallen. Central banks are purchasing gold at record pace, a sign of hedging against dollar exposure. None of these developments individually signal collapse, but collectively they indicate a world gradually repositioning itself. Crucially, de-dollarization isn't only about abandoning the dollar, it's about reducing overconcentration. Many nations still use dollars for convenience, but they are increasingly inclined to diversify. When enough countries take incremental steps in the same direction, the network effects that sustain the system begin to weaken. The real catalyst for this acceleration, however, may be a psychological one: confidence. For the first time in decades, countries openly discuss alternatives without fear of destabilizing the system. Global institutions debate currency, multipolarity. Financial analysts model scenarios where the dollar becomes first among equals rather than the unchallenged hegemon. When beliefs shift, behavior follows. This is not yet the end of the dollar, but it is the end of an era where its dominance was unquestioned. As de-dollarization spreads, the petrodollar system weakens, not through sudden collapse, but through steady erosion, a process that once begun is difficult to reverse. The historical cycle. Why reserve currencies rise and fall? To understand the transformation happening today, we must look back through history. The dominance of the US dollar is often framed as exceptional, as though no global reserve currency has ever been as powerful, as universal, or as indispensable. But history tells a different story. Every major financial empire, from Renaissance maritime powers to modern industrial states, has followed a recognizable arc. The rise, peak, the overextension, and the gradual decline. The dollar is not exempt from this cycle. It is merely the latest participant. Consider the Portuguese real in the 1400s and 1500s, the currency that fueled the first global trading routes. As Portugal expanded its influence across Africa, Asia, and the Atlantic, its currency gained acceptance as a trusted medium of exchange. But the very same forces that empowered it, overseas, expansion, and military campaigns, eventually overstretched the state. As new rivals emerged and Portugal's relative economic share shrank, the real lost its primacy. The Dutch guilder succeeded it. The Dutch Republic built the most sophisticated financial system of the 1600s, pioneering central banking, stock exchanges, and global trade networks. For a time, Amsterdam was the undisputed financial capital of the world, but military commitments, economic competition from England, and the rise of new trading powers eroded the guilder's centrality. The currency remained influential, but the world had moved on. Then came the British pound, the Industrial Revolution, global naval dominance, and the vast British Empire. The pound sterling became the backbone of 19th century finance. London's banks, insurance companies, and clearing networks dominated global commerce. Yet even at the height of its power, the seeds of decline were visible. 2 world wars, rising American industry, and the immense cost of maintaining a global empire. By mid-20th century, sterling was no longer capable of anchoring the world economy. Each cycle lasted roughly 80 to 120 years long, enough that contemporaries assumed their system would last forever, yet short enough that history could clearly compare them. The decline of a reserve currency is rarely sudden. It is gradual, structural, and often invisible until late in the process. The dollar's ascent began in the early 1900s, but solidified after World War II. When the United States emerged industrially unscathed, while Europe and Asia lay in ruins, Bretton Woods formalized the dollar's supremacy by pegging global currencies to the dollar and the dollar to gold. When gold convertibility ended in 1971, the petrodollar system replaced it, ensuring persistent global demand for U.S. currency despite the loss of the gold anchor. This brings us to one of the most important concepts in currency dominance: network effects. A reserve currency is powerful not simply because of its inherent quality, stability, liquidity, rule of law, but because the rest of the world uses it. The more a currency is used, the more convenient and efficient it becomes, which incentivizes even greater usage. This positive feedback loop creates incredible resilience. But it can also work in reverse. Just as rising usage strengthens the system, declining usage weakens it. When countries diversify reserves, invoice trade in alternative currencies, or build independent payment rails, they slowly erode the network effects that sustain the dominant currency. No single defection matters, but dozens do. This dynamic defines every reserve currency decline in history. None collapsed overnight due to a single event. Instead, each entered a phase where rivals emerged. Structural imbalances grew, and confidence slowly drifted elsewhere. When global users begin to ask whether a currency will remain dominant, the cycle is already underway. Today, the dollar faces the same forces that reshaped past financial empires: rising competitors, costly geopolitical commitments, internal fiscal pressures, and shifting economic centers of gravity. The U.S. is no longer the world's largest exporter, nor its sole industrial power. Its debt has reached historic highs. Its geopolitical reach, once uncontested, is now challenged by multiple regional blocs. Its sanctions regime, a powerful tool, has incentivized the creation of alternative systems. In short, the conditions that once ensured unquestioned dollar dominance are changing. And history teaches us that once a reserve currency enters the late cycle phase, momentum matters as much as fundamentals. Confidence shifts subtly, then rapidly. Users diversify just in case, which accelerates the loss of influence. The incumbent still remains powerful, but no longer unassailable. This is where the dollar appears to be today. It's not collapsing, not disappearing, but entering the gradual, recognizable stage of a reserve currency, has long declined the same stage where the guilder once stood, where the pound once stood, and where history tells us all dominant currencies eventually arrive. Signs the petrodollar system is unraveling now for years. Discussions about the fall of the petrodollar seem speculative, almost theoretical. But over the last decade, and especially the last 2 years, events have accelerated at a pace few analysts expected. What was once a hypothetical scenario has turned into a measurable trend. The unraveling is not complete, but the indicators are undeniable. The first major sign is the shift in global reserves. At the turn of the millennium, roughly 70% of all foreign exchange reserves held by central banks were denominated in US dollars. Today, that figure sits near the upper 50% range. No other currency has replaced the lost share. Instead, reserves have diversified into euros, yen, yuan, and especially gold. Central banks are buying gold at the fastest rate in half a century, a clear signal they are hedging against dollar exposure. The second sign involves global trade settlement. For decades, the dollar represented more than 80% of global trade invoicing. It dominated commodity exchanges, energy transactions, and multinational contracts. But since the early 2020s, the share has declined meaningfully. China now settles a growing portion of its international trade in yuan. India has established rupee-based settlement mechanisms with multiple partners. Russia and many of its buyers have abandoned the dollar almost entirely. Even long-standing U.S. allies have begun experimenting with alternative invoice currencies. The third sign concerns the heart of the system: oil. The petrodollar arrangement relied on the assumption that oil, the world's most traded commodity, would remain priced in U.S. dollars. But for the first time since the 1970s, major exporters have accepted or negotiated oil deals in non-dollar currencies. China and Saudi Arabia have discussed yuan-denominated oil contracts. The UAE has settled energy sales in yuan. Russia accepts a wide range of currencies. Even smaller producers have shown willingness to diversify. None of this destroys the dollar overnight, but each transaction loosens the foundation of the petrodollar era. The fourth sign is geopolitical. The world has shifted from a unipolar structure to a multipolar one. New alliances and blocs, BRICS, plus the Shanghai Cooperation Organization. Regional partnerships across Africa, Asia, and South America increasingly seek independence from Western financial systems. These groups openly discuss creating shared currencies, clearinghouses, or commodity-backed instruments to settle trade. While none have achieved full functionality, the intent is clear: to reduce reliance on the dollar-dominated architecture. The fifth sign is technological fragmentation. Digital payment systems, central bank digital currencies, blockchain-based settlement networks, and bilateral clearing arrangements have multiplied. These systems bypass SWIFT and U.S. banks, the very channels that once guaranteed America's financial supremacy. China's CIPS system, India's UPI integration, Russia's Mir network, and regional digital currency experiments create parallel rails that can expand rapidly. The more these alternatives gain traction, the less indispensable the dollar becomes. The sixth sign is psychological. Perhaps more than any other factor, confidence sustains a reserve currency. For decades, global leaders publicly affirmed their commitment to the dollar-centric system. Today, the rhetoric is shifting. Nations once hesitant to question dollar dominance now openly speak of monetary sovereignty, financial multipolarity, and de-dollarization. When belief in permanent dominance wanes, behavior follows. And when behavior changes at scale, the system enters a self-reinforcing transition phase. Importantly, none of these signs indicate imminent collapse. The dollar remains the world's most liquid, trusted, and widely used currency. U.S. financial markets remain unmatched in depth and transparency. But the trajectory is unmistakable. The system is no longer strengthening. It is slowly loosening. And once the underlying network effects erode past a certain threshold, the transition accelerates. We are witnessing the early to middle stage of this transition today. Enough change to be undeniable, but not yet enough to displace the dollar entirely. The petrodollar system is not dead, but it is dying. And the world is preparing for what comes next. What comes after the petrodollar? A new global financial, if the petrodollar era is ending. The natural question becomes, what replaces it? Will a single new currency rise to dominance? Will multipolarity define the future? How will nations, markets, and individuals adapt to a world no longer anchored by a single financial center? The first scenario is a multipolar currency system, where several major currencies share global responsibilities. In this world, the dollar remains influential but no longer singular. Euro, yuan, and potentially new regional currencies play larger roles in trade and reserves. Countries select settlement currencies based on convenience, political alignment, and transaction type. This scenario doesn't require any currency to defeat the dollar. It simply reduces concentration risk across the system. The second scenario is the rise of the yuan, especially in energy and manufacturing trade. China is the world's largest trading nation and one of the largest importers of oil. As China builds long-term energy partnerships and expands the use of its currency through swap lines and digital platforms, the yuan could become the dominant currency for trade in Asia, the Middle East, and parts of Africa. However, capital controls and political risk limit the yuan's ability to become a full global reserve currency in the short term. The third scenario involves commodity-backed instruments. Nations frustrated with fiat volatility may experiment with settlement systems backed by gold or baskets of commodities. Such systems appeal to countries seeking stability without relying on any single nation's currency. Several blocs have discussed this possibility, though implementation remains complex. The fourth scenario is technological displacement. Digital currencies, whether decentralized or state-backed, could create new forms of cross-border settlement. Instead of a single global reserve currency, the world could rely on interoperable digital networks that transact instantly, securely, and without traditional intermediaries. This model would fundamentally reshape the meaning of reserve currency. The fifth scenario, perhaps the most probable in the medium term, is a hybrid transition. The dollar remains dominant, but steadily loses market share. The yuan, euro, and other currencies rise in regional importance. Gold plays a larger role in central bank reserves. Digital payment systems bypass traditional banking. Energy and commodity markets diversify invoicing currencies. In this world, power becomes distributed. No single country has the leverage the United States once held. Trade becomes more complex, but more balanced. Nations gain autonomy, but lose the convenience of a universal settlement standard. Financial markets become more volatile, more fragmented, and more competitive. For the United States, the end of the petrodollar era carries profound implications. The free lunch of unlimited cheap borrowing will fade, deficits will matter again. Inflationary pressure may increase as foreign buyers reduce their purchases of U.S. debt. The dollar will remain important, but its supremacy will feel less like destiny and more like competition. For the rest of the world, the transition brings both opportunity and risk. Countries previously constrained by dollar dependency may gain room to maneuver. But fragmentation can introduce uncertainty, short-term instability, and unpredictable capital flows. Investors will face new dynamics, new hedges, and new geopolitical considerations. The most important transformation, however, is philosophical. For 50 years, the global system revolved around a single financial axis. The United States issued the reserve currency, protected the sea lanes, anchored the banking system, and supplied global liquidity. In the emerging world, no country plays that role alone. Cooperation replaces dominance. Networks replace monopolies. Systems replace empires. The death of the petrodollar is not merely a monetary event. It is geopolitical, economic, and civilizational. It marks the end of an era where a single nation shaped global finance. What comes next will define the 21st century. Not a unipolar world, but a world of competing centers of gravity. As the old system fades, a new one forms, slowly, unevenly, and inevitably.